Hi there, welcome back. As we go into the prototype of the financials of a small business, it's important to also understand the financial performance as a glance in just simple calculation formula. Your cost plus your profits equals to your selling price, as we mentioned earlier. Your revenue minus your direct cost, which gives us your gross profits, and of course your gross profit minus your expenses is what gives us the net profit, which is what the statement of profit or loss should always show us at the end of the day. Now let's move into the prototype of what a financial statement should look like, at least for a small business not having so much activity. Now this is an example of early finance. It's just an MSME, right? So now I'm going to show you the statement of income, which is the COCI SOCI, and this shows the revenue. As you can see, the revenue for 20x5 and 20x4. So usually financial statements are prepared comparatively, meaning that you have the current year figures versus the previous year figure. So this is important for the purpose of comparative analysis. You are able to, at a glance, check your performance in the current period against the previous period. Now for early finance, we can see the revenue in 20x5, the revenue in 20x4. You can also see the cost of sales. That's the direct costs they have to incur to earn this revenue, and the revenue minus the direct cost is what gives us the gross profits, right, for both periods. And we can see in 20x5 gross profit is about $127 million. In 20x4 is about $129 million approximately, and of course administrative expenses, other expenses that needed to be incurred, right, for the purpose of running the business. We can also see what that looks like. It is $7,090 million here, right? And this now shows the profit or loss before tax. It's important, profit or loss before tax. Then when we then calculate our tax, then we have 11,000. The assumption is that in 20x5 we've had to pay tax of 30% on the profit. The assumption in 20x4 is that the business is just starting and they were able to get the relevant tax authority to not pay tax for that year. Now the net profit or loss for the year for 20x5 is this, for 20x4 is this. So just looking at this comparatively shows that the business seems to make more profit in 20x4 than 20x5. However, this is as a result of the fact that 20x4 no tax was paid, no corporate tax was paid. Now let's move to statement of changes in equity. So this just only explains to us how the owner's fund changes during the year. For example, you will see that as at the beginning of the year, you have the figures to be the ordinary share. Those who own shares in the business is valued at 15,000. The retained earnings, those are the profits we have kept over the years into the business for the purpose of expansion, is also 27,000. Yeah. So what that has just told us is that now the profit for the year, is 27,000, right? So, and we also assume that we pay dividend, say, to our shareholders as a return on their investment for investing in our business, 30,000. So what this just showed during the years to say, okay, how did our equity change? How did our capital change? So at the end of the year, we now say, we still maintain our share price as 15,000. Now retaining earning has reduced because we've paid dividend out of it. Then, of course, this speaks to the total. So this is like the total owner's fund that we have as at 20x5, year end of 20x5. Then we move to the statement of financial position. Like I mentioned earlier on, the statement of financial position is supposed to show the financial health, state of affairs of the business. And of course, we can then see what the asset looks like in 20x5, right? That's the property, plant and equipment as was explained earlier on. And of course, we also see what the liability also looks like, which is trade and other payables. And of course, the equity, because a statement of financial position, like as mentioned earlier on, should show, right, the assets, the liability and the equity. And of course, the liability plus equity, whatever figure it is, must be the same thing as a total asset, right? So that is what a statement of financial position shows. Then to the fourth account for statement, that is the statement of cash flow. So the statement of cash flow, as mentioned earlier on, is to tell us the sources and uses of funds, and also the inflow and outflow of cash in the business. Now, for the purpose of preparation of this, cash flow statement is divided into three segments. We have the operating segment, operating activities, we have the investing activities, and we have the financing activities. The operating activities involve activities around the operations of the business. If you are using an indirect method like we use here, the first thing you have is your profit for the period, right? You add any non-cash item, you add them back, because when you calculate profit in accounting, we use accrual basis, and for accrual basis we would have adjusted for items that does not involve the inflow or outflow of cash. So in that regard, because we want to have a true position in terms of cash or the liquidity of the business, what we have to do is to add back non-cash item. And of course, if there is any movement in working capital item like receivable, like payable, your current asset, all item under your current asset and current liability, if there is any change between the 2 years, it means that cash has either gone out or you have received more cash. For an example, if the total value of inventory or stock that you have in 20x5 is $10,000, in 20x4 it was $8,000. What does that mean? It means that in 20x5 you have had to purchase $2,000 more of inventory, because what would you add as a last year was $8,000, and this year you are saying you have $10,000. Then it means that $2,000 of goods have been purchased, and when you purchase goods, what happens? It leads to cash outflow because you have to pay. So that way we will come here and also subtract that, because it is a cash outflow. And after we've gotten that, then we then move to cash flow from investing activity. This involves buying anything, like we explained the meaning of investment. It involves buying anything that you need to use in the business for a longer period of time. You expect return from them. If you buy an asset, for instance, that way it is an investing activities, because it's an investment. You expect that you use it over time, so that is captured under investing activity. Anything you buy that are capital in nature, use them for more than 1 year, it is termed investing activity. And of course, we then have financing activity. So financing activity is every activities that involve funding or financing the business, right? For example, if you had to pay dividend to your shareholders, that is a financing activity. Why? Because your shareholder are the one who finance your business. So if you pay them dividend, it's part of the expense you have to incur to ensure that there's constant financing to your business. And because you are paying out dividend, is an outflow. That is why we have to subtract it here, because money is going out. Yes. Then of course, at the end of the day, you have your net cash flow for the period. Net cash flow is the addition of your total cash flow under operating activity plus total cash flow under investing activity plus total cash flow under financing activity. And at the end of the day, you then have your opening cash and cash equivalents, then you get your closing cash and cash equivalent for the period. Thank you very much.